Hello everyone and welcome to this session on enhancing business intelligence with PyMC3. My name is Michael Grogan. I'm a data science consultant and educator from Ireland. And in this session, we're going to be looking at how Bayesian analysis can be used to analyze business intelligence problems and solve business intelligence generate business intelligence solutions using Bayesian methods. And just a little bit about myself. My name is Michael Grogan. I am a data science consultant and educator from Ireland. I specialize in analysis of business data, particularly using time series forecasting techniques. And in this presentation, we're going to be looking at how we can generate superior forecasts using Bayesian methods. Now, before we dive deep into the methodology itself, just a little bit of an overview of what Bayesian analysis is and why we might want to use it. Bayesian analysis is based on probability. The traditional statistical school of data science, for example, might say that, we might build a time series model to forecast with certainty what's going to happen in the future. But Bayesian analysis says that we want to be able to use probability-based forecasts to do this instead. We know that if we try to build a model to forecast the future, we're not always going to get it right, even though we might try our best to build, say, an ARIMA model or an LSTM model to forecast what's going to happen in the future. Bayesian analysis rather takes the view, okay, let us try to forecast the worst case scenario, the best case scenario, and also let's try to forecast the most likely scenario as well. So for example, let's take an example of the airline industry. The airline industry in 2019 might well have created several time series forecasts of air passenger numbers in 2020, for instance, but COVID-19 will have come along and all those forecasts will have been rendered invalid. Bayesian analysis allows us for more flexibility in terms of being able to forecast the worst case scenarios and the most likely scenarios as well. The advantage of Bayesian analysis as well is it takes individual expertise into account. Let's say, for example, that you have domain knowledge on a particular topic and you want to be able to leverage that knowledge in your analysis. Bayesian analysis allows for prior beliefs and how it influences the posterior distribution, and it's less black box in that it allows for a more subjective opinion of what's going to happen as opposed to simply garbage in, garbage out, putting data into a model and seeing what it comes out with. It also reduces the need for vast data collection. The premise of Bayesian analysis is to be able to conduct many simulations of a particular data set and come up with many different scenarios of what might happen, what could be forecasted to happen. Now, in machine learning, we need a vast amount of data to be able to train the models from scratch, and this isn't always efficient, whereas with Bayesian analysis, if we can do different simulations, then this makes our job a lot easier in terms of generating sufficient data needed to build robust models. Now, just before we get into the code, we're going to talk about the prior and the posterior distributions. Now, the prior, as I mentioned briefly, is our prior beliefs about what is going to happen. For example, let's say we are analyzing fuel efficiency across cars, for instance. I could have the prior belief that larger cars are more fuel efficient than smaller cars. However, that's just my prior belief. I don't have any data as of yet to back that up. Which brings us to the likelihood function. Once we've formulated our prior belief, we then come up with a likelihood function, which is the actual data that we are observing. And then when we combine the prior beliefs and the likelihood function together, we come up with a posterior distribution, which adjusts our prior distribution based on what we have actually observed. And given the fact that many forecasts that businesses will have made in 2019 have now been rendered invalid by COVID-19, you may well see that Bayesian analysis is going to become more popular because people are realizing that traditional statistical forecasting has its place, but when it comes to analyzing the worst and the best case scenarios, Bayesian analysis is a lot more adept at allowing us to be able to do this. So what I'm going to do is we'll toggle out of the slides here, and I will show you how we're going to analyze hotel cancellations using PyMC3. Now, let me just show you the data set here. This data set is a data set of hotel cancellations. We can see that we have a 0 for customers that don't cancel their hotel reservation, and we have a 1 for customers that do. And this particular data set, the original data sets are available from Antonio Almeida Nunes. This is research that was originally conducted by these experts, these researchers, and you can dive in further on this topic if you would like. Now, what we want to do is we want to take a time series of cancellations. Let's suppose that we have aggregated the hotel cancellations from the previous data set, and we have the number of cancellations per week. Now, from a Bayesian standpoint, we might have prior beliefs about what the hotel cancellations are going to look like, whether it might be a normal distribution or not, for example. And we want to be able to come up with a posterior distribution that allows us to determine what's going to be the highest number of cancellations we can expect, what's going to be the lowest, and what is the most likely outcome as well, the mean of the distribution. So what I'll do, I will go ahead and run through the code here and explain everything as I'm doing that. We're importing our data. Now, what I will do is, here is a histogram of our data. You can see that on the lower end we have roughly 20 or so calculations, 200 plus on the higher end, and then we have the mean. We have a mean of 96 cancellations in the data set and a standard deviation of 45. Now, when running a Bayesian model, let's assume we don't know anything about the shape of the distribution. Let's assume that all we know is that the minimum number of cancellations is 14 and the maximum is 222. That's all the information that we're given, and it's up to us then to determine select our prior mean and standard deviation, and then generate a posterior distribution based on that. And so what we're doing here is we are selecting a prior mean of 120. Now, how we got to that is because we have a minimum of 14, a maximum of 222, we're just going to say we're going to take the mid-range of that, 120, for simplicity's sake. We're going to assume that there is minimal standard deviation in the distribution. We're going to assume a sigma of 10. And we're going to generate 1,000 different simulations based on this in order to generate the posterior plots. And what's being used here is what's called the NUT sampler, or the no U-turn sampler. Now, if we go to the PyMC3 documentation while that's running, just bear with me 1 second. Okay, you can see that the documentation describes it as a type of a Monte Carlo method, but more efficient in that it's better at sampling. It has to take fewer points for sampling than a traditional sampler does. And we're not going to necessarily get into all the mathematics of why this type of no U-turn sampler can be more efficient, but suffice to say that it is commonly used in Bayesian methods. Now, you can see here that it's sampled 4 chains, and it's taking 4,000 draws total. And you'll see more intuitively why this is important in just a bit for generating the posterior distribution. Okay, so let's have a look at the posterior plots. We have a mean of just under 100. Standard deviation is a lot higher than the prior standard deviation that we selected of 10. There's some summary statistics here. And there are several plots that will be generated, but what I want to show you in particular should be generating now. Okay, we have our posterior predictive observations, and we have the true mean as indicated by the red line, and then we have the black line, which is the observed observations. So what this model is doing is it's taking our prior assumptions, it is checking that against what is actually observed, and then it's coming up with a posterior predictive mean, and then posterior predictive observations, which is many simulations of hotel cancellations, as you can see in the plot. Now, post-COVID, for example, we might come up with the assumption that hotel cancellations are going to be a lot higher. Instead of a mean of 120, we might come up with a mean of 400, for example. But if we were to base that on, say, March 2020 figures, there's still a chance that we might be wrong. Maybe hotel cancellations have gone down in the meantime. We don't know. And the only way to know is to compare it against the likelihood function, against the actual data. So that's what we aim to do when we are generating the posterior distribution here. Now, just to toggle back to the slides a second. We can also use PyMC3 for time series analysis, and specifically to identify the properties of a time series. Let's toggle back to the time series for a moment. You can see that we have data from June 2015 all the way up to August 2017. Now, we want to check if this time series follows an AR1 process. In other words, a process whereby the value we observe at time t is dependent on the value at time t minus 1. Now, we could say, for example, generate a partial autocorrelation function on the data I've just shown you and see whether it follows an AR1 process, for example. But how do we know that this time series will always follow an AR1 process? For example, we might find that from 2015 to 2017, it does follow this process, but we can't be sure whether it will across other time periods, for example. And what PyMC3 can be used to do is, again, to generate multiple simulations of that time series to see if during different time periods, the AR1 process might still stand. And what I'll do, I'll navigate down to the code again here. And what we're going to do is take the observed time series, the observed data, and generate 2000 samples. We're using the NUTS sampler again. And we have a mean of 0.88, and we have a 94% confidence that the strength of the correlation lies between 0.8 and 0.95. And from that regard, we can be reasonably confident that it is following an AR1 process. And again, because we've generated 2000 different samples, we're generating 2000 different potential paths or observations for hotel cancellations. So that's the advantage of Bayesian analysis, in that we're not simply looking at the one series, we're generating many simulations based on the properties of that series and then inferring from there. And this comes back to what I was saying before about not having the need for excessive amounts of data. So we wouldn't have to sample many different time periods. For instance, we can simply generate simulations based on the properties of the time series and infer from there. Now, what we can also do, again, looking at this from a time series perspective, is volatility modeling. Now, The example given in the PyMC3 documentation, which is quite an interesting example, is that of using stochastic volatility to analyze stock returns. Now, in any time series, there's going to be a lot of noise in the short term. You're going to have these random fluctuations that can't necessarily be predicted in their own right. And so the closest we can get to that is predicting the volatility behind those short-term fluctuations. Now, just to show you in the documentation the example here of the stochastic volatility. Yep. So PyMC3 is explaining how they use the no U-turn sampler once again to analyze daily returns of the S&P 500 stock market index. And you can see here that there's quite a lot of noise day to day in that time series, but it can be used to generate different paths of volatility, as you can see here, the volatility process. Now, what we're going to do is we're going to do the same thing, but we're going to do this using the hotel cancellation time series. Now, admittedly, there will be a little less noise in this time series because we're using weekly instead of daily data. A good rule of thumb is that the longer the time series is, the less noise you're going to see in that time series and the more signals. For example, if you have, say, a monthly time series, there's going to be more meaningful information in that series than in a daily or an hourly time series where there's a lot more fluctuations. So let's go ahead and run the model. We're using the student t distribution to model the volatility process here. We generate 1,000 samples. RViz is being used to generate the plots for this. It's a separate library that we're using in conjunction with PyMC3. This might take a little while, so I'll just go ahead and run the remaining lines. But what you'll see, or what we expect to see when we generate the volatility chart, is we expect to see the fluctuations in weekly hotel cancellations, but then we also expect to see many different paths or different volatility generated scenarios of where hotel cancellations could be. So it'll be interesting to see if what is generated remains within the range that we are predicting, or the range that that was included in the data set itself. I think if memory serves, the lowest number of cancellations was 40 and the highest was 222. Perhaps in this scenario we might have a situation whereby the cancellations are significantly higher, but we'll see once it runs. And depending on the number of samples you need to run, it'll take longer time accordingly. So it depends on what system you're using, how much data there is, how many samples you want to run, etc. Almost there now. Okay. Now, Here is the mean and the standard deviation of the volatility that's generated. But what we're really interested in is looking at the stochastic volatility process here. We can see that the blue line is the number of hotel cancellations, but then these red lines are a series of potential cancellation paths based on the properties of the time series. And you can see that even though the highest in our data set was 222, there's one particular point where it's as high as 350 and a couple where it's as high as 250 as well. The cancellations generally they generally don't go below, say, the 50 level. It looks like the actual cancellation time series actually shows lower numbers of cancellations than the vast majority of the generated paths. So we can see that when we look at stochastic volatility, the cancellations are actually skewed to the upside. And somebody who's, say, looking at this pre-COVID could say, okay, the forecasts are biased to the upside. There could be a situation where we might have potentially up to 350 cancellations, even though we haven't experienced that during this time period. And that's where the beauty of Bayesian analysis comes in. It's being able to take the property of a time series and be able to look and say, okay, this hasn't happened yet, but this particular scenario could happen in the future. And as a business, what action are we going to take if it does? So using a traditional time series model, we may find that the forecasts will stay largely within the range of the original time series. But when we take a more holistic look at it and we look at the properties of the time series itself, then we come up with much better insights. Now, just to toggle back to the presentation here, the next thing that I want to look at is this idea of posterior predictive regression lines. Now, let's supposing that we want to look at this data set more broadly. We've looked at the time series, but we also have the number of cancellations. We also have lead time. Lead time across the hotel industry means the time when a customer makes a hotel booking and when they actually stay at the hotel. So say if I make a hotel booking in October and then stay at the hotel in January, that's a lead time of 3 months, but it's given in days here. We have as well the ADR, or the average daily rate, which is essentially the average price that a customer pays every day when they stay at the hotel. Now, let's suppose we wish to conduct a regression on this. Let's say we want to analyze the relationship between ADR and lead time. Is there a correlation between the length of time between a booking and a stay and the rate that a customer pays per day at the hotel? Is there a meaningful relationship between that? Now, again, if we wanted to use standard regression analysis, we could simply run a regression, take the x and y of the data that we already do have and find the slope and the intercept. But again, that's only telling us about that particular instance. It doesn't necessarily tell us about, different scenarios that we might face. So let's go ahead and see how we would do this. We just let you know the template, or the original template, is for GLM linear regression is found at the PyMC3 documentation as well, so you can have a look at this if you want more information. Let's just go ahead and load our libraries. We'll import the data set that you just saw. We're going to take lead time and ADR. ADR is our outcome or dependent variable. We're taking the lead time as the independent variable. We regress them together and we get a slope of 0.019, intercept of 93. Let's take this into account and generate 2,000 posterior samples using the no U-turn sampling method. And what this is going to do is it's going to generate many different regression lines so that we can see what the relationship would be under many different scenarios. So this shouldn't take too long to run, and we'll just have a look at the regression lines. We have our intercept, our x or sigma. Now, on the whole, this is the true regression line, which shows virtually no relationship between ADR and lead time. Again, we're running across just one data set. We have many different regression lines where a lot of them show no relationship, but there are certain cases where we do identify somewhat of a positive relationship between ADR and lead time. So the higher the lead time, the more that the customer can be expected to spend at the hotel. Now, that might be due to, say, for example, a customer who has booked their hotel room well in advance. Let's say they're going on holiday, they've been planning this trip for a while, so they're intending to spend more than customers who have maybe made a booking last minute, for instance. We don't have enough evidence to infer that, but we have a number of regression lines that are sloping upwards, so that might be an indication there. Let's have a look at another hotel data set. We've analyzed Hotel 1. Let's analyze Hotel 2. We will, let me just clear this here. And I will go ahead and just get the new intercept and slope. So new slope is minus 0.05, intercept 111. Again, we're using a size of 115. And go ahead and again, we see a similar true regression line, virtually no relationship, even if slightly negative. 2000 posterior predictive regression lines. Once again, that's what we want to generate. Again, the no U-turn sampler is running. Again, we observe something similar. We see that the regression line is slightly negative, so we have some negative regression lines, and then we have some positive regression lines as well. So this is a little bit more inconclusive. Overall, from analyzing the two data sets and generating the 4,000 regression lines in total, there doesn't appear to be a particularly strong correlation between ADR and lead time, whether positive or negative. But again, the beauty of using Bayesian analysis in this way is that we don't have to analyze vast amounts of data to be able to generate this. Instead, we can take the properties of the data set and then look at what analysis can be drawn from analyzing different simulations. So to wrap up this presentation, predicting the future is always hard, and as data scientists, we like to think that we can predict the future, but that's not always the case. Instead, what we can do, the value that we can add, is to come up with a probability-based analysis of what could happen. What's the worst case scenario, the best case scenario, the most likely scenario, and the information that we provide there is of more actionable insight and allows businesses to make better decisions. And as I mentioned, particularly after COVID-19, this type of analysis is going to be of more interest to businesses going forward. Many businesses are now going to want to increasingly prepare for worst case scenarios, and traditional statistics has certain shortcomings in being able to model probability-based scenarios like this, and PyMC3 and Bayesian analysis can really be of help when it comes to quantifying unknown unknowns. So that's all I have for you today. Many thanks for your time, and really hope you enjoyed the presentation. Please let me know if you have any questions. Thank you.